Trading strategies can be incredibly complex. They can require several steps and measurements, and some are just downright confusing with a million steps along the way. Welcome to trading, I suppose, but there are a lot of things that we can really do to kind of work on that first. Hey there, how's it going? John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, I wanted to take a step back and see if we can create an incredibly simplified trading strategy that can still capture with trend moves as well as reversals. Of course, we need to be realistic here. We can't expect to find the golden goose, right? Nothing is foolproof, and there will be setups that fail irregardless of what we do. It does not matter. There will be failure patterns because that's trading. The majority of complications in trading, though, and really the majority of complications in trading plans, comes from the over-optimization to curb fit it to the latest few patterns that maybe didn't work out, right? A lot of traders over the last few patterns that may have failed, they'll try to modify the approach, modify the strategy to make it fit so that those last few trades that were losses are now winners, and it pads the numbers and makes it look all nice and fancy. But the problem is when you do that, you're taking away from the long-term statistical probability. You have to understand that with trading, there are going to be losses, and curb fitting a strategy to fit what's been going on the last few days is a surefire way to run into some trouble. Do not fall into that trap. Keep it stupid simple, as they say, right? KISS. So let's start with the basics. Here, I've got a 60-minute chart with a 200-period SMA on the mini NASDAQ. And that's it, right? There's nothing else on there. Sure, I've got the current price line on here, so I know where the current price is. And I believe it does also have the label for horizontal lines. But that's it, right? We've just got the 200-period moving average on here and nothing else. But let's have some fun with this. Instead of just the 200-period moving average, because everybody already uses that, already knows about it, etc., let's have Google tell us what to use, right? So let's go in here and see, how about a random number between, we don't want to go too low, so let's start at like 20 and 200. We'll go up to the 200-period moving average, and we'll see what happens. 160. Perfect. That's what we'll go with. It's a pretty big number there, but let's stick to that. So we've got a 160 period moving average. And with this moving average, really what I want to do is, I want to, well, typically, for me at least, I'm a with trend trader, right? So with a trend, a pullback, a build-in style trader, I love buying the dip, basically. That's usually my forte. But again, we're trying to make this interesting. So let's stay away from that, and we'll go from the normal buy the pullback momentum to buying the breakouts instead. That is usually a little bit out of what I'm normally doing. I'm a pullback trader after all, so buying the breakout is a little bit out of my comfort zone, right? So let's take a look at this as more of a breakout scenario, and because of that, we're going to need something that makes a very obvious breakout point. I mean, just looking at the chart, one of the most obvious things are swing highs and lows, right? So let's highlight them. Let's make it easy on ourselves. We'll go down to the swing indicator. I'll just use the S. There we go. We'll go down to the swing indicator. There it is. And let's set the swing strength. I don't want to swing a 1. That might be extreme. Let's set it to 5 and see what happens. Actually, you know what? Hey, let's stick with the plan here and have Google tell us what number to use. Random number between 1 and 10. Perfect. 4. That's what we'll use. We'll stick with it, right? We'll keep it at the heart of the mentality here. We got 4 on the swing indicator, and that's what we'll stick with. Now, the idea here is, from a breakout perspective, well, we have some very obvious things going on. Obviously, when the market is below the moving average, generally speaking, it's considered bearish. When the market's above the moving average, it's considered bullish. Pretty common sense stuff, right? But we can dig into this a little bit further in terms of giving us a directional bias. Now remember, we want to make sure that this is working on both trends and reversals. So we need a bias, we need a direction, something to filter out the opposing trades, or to give us the flow of the river, if you will. Well, we have swings and we have a moving average, and I really don't want to make it much more complicated than that. So let's make it easy. If the market's above the moving average, it's bullish. Easy enough. So there's rule layer number 1. As long as it's above the moving average, we're bullish on the 60-minute chart. Now we can go into, let's say, a 15-minute. I do love a good 15-minute chart. And we're going to be looking for only bullish continuation plays. Now, obviously, there's 1,000,003 different ways that we can look into this, but we're trying to find the easiest way in, right? So let's maintain that mentality. We could look for patterns, we could look for wedges, we could look for flags, we could look for Fibonacci ratios and pullbacks XYZ. But again, let's keep this simple, really, really simple. We have the swing indicator. We know that we're trying to get breakouts. So what better approach for a breakout than looking and waiting for the market to plot the first swing above the moving average in the directional bias of the larger time frame. The larger time frame, after all, is bullish. So the first time that we create a swing high point above that moving average, that's my break point. Now I have the point of interest that the market should break above in a continuation formation, right? Very, very straightforward. Not a whole lot of thinking involved in this. Again, the point of this is to keep it simple. So let's see how this kind of played out. One thing that might actually help is creating two charts side by side and connecting them with a global crosshair, so we don't have to keep going back and forth between the 15-minute and the 60-minute. So now that we have a chart layout that's a bit more reasonable, now we can link them together. We'll use the global with the time scale. We definitely want that to be scrolling along with. Let's do the same thing over here. And now wherever we move the crosshair on the 15-minute chart, it will show us where it was on the 60-minute chart as well. That'll make it a little bit more obvious as to where we were looking at. So let's continue this mentality and keep on going along with it. Obviously, towards the end of price action, the market has been bullish, and it was bullish if we're looking at the 60-minute chart. It crossed bullish comparatively on the 15 right about here. Right? So that's the point where the market crossed into bullish territory on the 60-minute chart. So we have to be reasonable in our expectation. We can't be looking for a long above this swing high if it wasn't bullish until up here. Right? So that's kind of a consideration that we have to make. After the market has gone bullish, we're waiting for the next swing high, right? That's as simple as it is. Now, we've got the next swing high, which plots right there, and that would show us our break point that we're looking for a continuation on. Now, is that a picture-perfect break point? Maybe, maybe not. What might be more beneficial is once the market has gone bullish to wait for it to dip underneath. But let's keep going with this mindset, right? We've got the breakout point. Again, I'm out of my comfort zone, so I'm trying to justify different ways to go about this. But let's keep it pure to the mindset. We're going for breakouts. If I were looking to take a breakout above this swing high, where would my stop have to be? At minimum, my stop would have to go underneath this last swing, and preferably even underneath this low. So if we're looking at it from a continuation perspective, let's place our risk tolerance just underneath that last swing. Our entry point would be as soon as it triggered above the high of that, and our risk would be down here. Now, would I be comfortable with a $5,700 risk per contract? Maybe, maybe not. But if we look at this overall, what can we see? If we zoom out, we know the market's bullish, but common sense would tell us that I've got a target that's up in the stratosphere right now. It looks nice. I love the idea of risking 6,000 to make 17,000. But let's be real here. A target above this previous resistance zone is going to be really difficult. There's a lot of crap over here. So if we're trying to play this from a realistic perspective, what kind of trader is this? Well, they're probably not a 3-to-1 trader, and they're probably not a 2-to-1 trader either. Same problem. So really the only type of trader that this could be, more likely than anything, is a scalper. And as a scalper, let's see if it fits. Now, the scalper, this is where it becomes interesting because they're risking twice as much as they're willing to make, but the goal here is probability. And if we're looking at probability, the highest probability, I suppose, would be underneath the low down here. Now, what's interesting is the response that we're seeing up here. You would think that this is some arbitrary swing in the middle of no mansville. This literally randomly generated swing indicator, randomly generated moving average, basically random rules just to try to figure out what's going on. And yet, the market still is responding off of these areas. That goes to show you that the market operates for an infinite number of reasons, and we're just trying to figure out where the majority of those orders come together to give us a bias. Here, it was a really nice example of a bullish breakout, but we couldn't justify bullishness until over here. Once that bullishness was justified, though, they had their move for the attempted target to the upside. Whoop, where'd it go? For the move to the upside to hit some of these objectives. So a lot of them taken out on that move up, and it's very interesting to see that response there. Just goes to show you how this can definitely work out, and those infinite possibilities, all those different traders entering and exiting at the same location. Well, there's a good example of it all following through. Now, if we go back a little bit further, right? Let's backspace a little ways here and go over here. Now we have another bearish situation, but it didn't go bearish until over here. Right there's a nice drive lower. Well, actually, we already know this one worked, right? I know it took a little bit of heat, but it all worked out. Let's find a sloppier area that's a little bit more kind of grotesque. Like inside here, when the market just begins the transition back to the upside, it didn't go bullish until technically right there on the open. Now, we did have a swing high that was completed all the way over here. And what's interesting is, as far as a breakpoint, we have two different measurements, right? They could be measuring underneath this most recent low. As far as a risk calculation goes, it's a very logical stop. Again, these are very likely scalpers. And here we can see that it worked out perfectly. But the other side of things would be a stop that's way down here underneath this most recent low, or even possibly underneath the major low way down at the bottom. Now, the market obviously did not make it there for quite a while. It took days to get there. But notice that when it did make its way there, finally, the response was incredibly aggressive. And when it finally broke through it, guess what acted as support later on, right? So very, very important areas derived from seemingly randomness, right? We kind of derived this pattern and this entire strategy, I guess we could call it a strategy at this point, out of sheer randomness, random numbers, random indicators. And again, the concept here is separating us away from making things overcomplicated. It's trying to figure out the easiest way to get into a move, keeping it simple, and trying to locate where the market is possibly continuing for a trend. But we also want to see, does it handle reversals? And as we saw, usually when the trend shifts to a different direction and starts rotating away, like over here, chances are there have been a lot of rotations on the 15-minute chart that have already given us clues that it's trying to rotate back up. And although there may be some false breaks to the upside, inevitably, when we get all of those things rolled into the right direction, we see that continuation follow through. And in this case, it didn't stop for quite a while before finally crashing down a bit later. Now again, this is just looking at a couple examples on the surface. Is this a viable strategy in and of itself with only two rules? Probably not, right? I mean, let's be real here. This has very little in terms of overall strategy and structure. But could this be the basis of a strategy or an approach? 100%. And that's the beautiful thing about trading. You can literally design a trading strategy around anything that you want. So if you find comfort in a moving average, the specific pattern of moving averages, maybe you love Fibonacci's, or maybe you love Ichimoku clouds, whatever it happens to be, deriving an adjustable pattern that we can use repetitiously to find ways into the market is easily designable. Once we have our base pattern in play, all we have to do then is design some simple rules around it. One of the obvious things for me, I'm not much of a breakout trader, so a direct entry right on a swing high is something that I'm not exactly familiar with. That's not my comfort zone. But we do know that there is a very repetitious pattern that tends to set up over and over and over again. Every time we have a new swing high in a bullish trend, it tends to break and go further. So for somebody like me, who's more of a pullback trader, it would be very easy to optimize this to fit a pullback strategy instead. Let's look at an example here, right? We know that the break point, if we go back over here, we've got a bullish rotation back to the upside, and this is really messy inside this overall move. But we know that we've got a bullish rotation to the upside. So as far as bullishness is concerned, kicking off to the bull side here, when we break above that high, that means that the bulls have been triggered in. But as a pullback trader, I may not necessarily want to buy right there on the breakout. I would rather buy when the market pulls back. But we need to find a favorable zone of interest. If I'm placing my stop underneath this low, but I want to trade, let's say as an example, a 2-to-1 setup, then taking a 2-to-1 with an entry point that's way the heck up here and a stop that's way down here may eventually work, right? But that's miles away. That's way out there. So in order to get this a little bit more realistic, what a lot of traders will do will drop their entry until they can get to a point where that 2-to-1 objective fits inside the highs. And what's funny is, when you start going back to these areas, you'll notice something happens. All of the sudden, you have incredibly obvious zones of support that stack up. There are no such things as coincidences in the market, and this is a perfect example of that. Buyers know that they cannot buy way the heck up here with monstrous risk, and if they want a safer way in, they're going to have to get in where a 2-to-1 actually fits. And that just so happened to be the exact low on that move lower. Well, I don't think just so happened to be maybe the right sentence here. So again, for somebody like me, I'm more of a pullback trader. I find more comfort in buying the pullback rather than buying the breakout. That's just me, but there's a lot of ways to optimize these and adjust them to fit basically any rule set. But designing the base point of finding an entry pattern can be very simplistic, even random, as long as you keep it simple. Don't make it too complicated. Keep it simple. I even had to tell myself that a couple times on this recording, that I had to keep it simple because I was starting to overcomplicate things. That's human nature for you, and that's also going to do it for this video. Hopefully you found it useful, interesting, entertaining, and something that you can add to your tool belt if you're trying to find or design patterns along the way for different market types, something that fits the bill. You can actually design a lot of really, really cool patterns around random numbers. It's one of my favorite things to do. But like I said, hopefully you found this useful. As always, if you have any questions, you can feel free to shoot me an email, jhb@ssftg.com. Don't forget, on the main page of SSFTG, you can also register for a free 1-week trial in the live trade room. And when you register for a trial in the live trade room, you also get our 24-page guide on risk reward, going over exactly what we're talking about here and how we view the markets. Obviously, you also get 1 week in the live trade room with us in the VIPs, and along with that, you can register for a 30-minute call. If you have any questions, we can sit down and chat and get all of that taken care of. That's going to do it for this one. Enjoy the rest of the day. I hope you had a fantastic one, and we will see you in the next video. Thanks.